All right, folks, welcome back. This is model number 5, algorithmic theory. And it's a intraday short-term strategy where I introduce the standard deviations and such, and I give you rules in that model and when to pick the flout and when to pick central bank dealers range and when to use the Asian session. So we don't need to go through all that. That's already been taught. So I want to take you into a market, Australian dollar. This is our daily chart versus US dollar. And we're inside that seasonal tendency that was bearish. Okay, we're looking at the daily chart here. We have a nice up close candle, and it's trading up into a breaker. High, low, higher high. Trades up into the breaker there. So we have a bearish bias, and we have a up close candle in a market that's expected to go lower. And we'll say it's likely to draw down into this area here in longer term, but again, we're just using this bias or these relative equal lows here as a means for determining the expansion where we're looking for. So we're expecting the next day to start working lower, but for intraday, where do we aim for? Well, we can start with this daily low. Okay, so we're going to look at that daily low as an objective for a short if we can get all the confluences. All right, so here we have a 15-minute time frame. I mentioned 15-minute time frame is kind of like the bellwether. So again, go through your model for model number 5, and you'll hear all that detail as well. But we're focusing primarily on a run below this low. Okay, so we want to know, can we get a setup that sets up a short that takes out this low, and how far can it go using model 5 precision elements with the standard deviations? So that's our pool of liquidity that we're aiming for. And obviously, with the benefit of hindsight, we can see it's over here. But we're going to put some math into it. Okay, so we're using the flout. And I went through all the rules. You can go through that for yourself. And this is what we're going to be utilizing. So we're using a high to the low. You always split that range in half, and then you can do your standard deviations set up that way. Or if you're Fibonacci set up in such a way where if you're taking the high to the low, the deviations or whole number deviations, it's not a matter of exactly how many number up or down. It's looking for a confluence, and that's one of the things I was trying to impress upon you in the model number 5. So it's a confluence of not just one day, but at least 2 days worth of confluences within the construct of a bias. Okay, so in layman's terms, I'm going to walk you through it. We're looking for how this day went up higher. We're expecting it to go lower because it's inside a seasonal tendency. We're expecting for that daily low to be taken out, and we want to use some precision elements to get us in sync with that. So I'm measuring the high to the low, and then what I'm doing is I'm determining that 50% level between that high and that low. Then I'm dropping the fib from that to that, so it gives me the 50 levels. Okay, and the only reason why I'm doing it that way, and it may be confusing to you, is I want to have smaller standard deviations instead of like what would be otherwise from here to here. What I'm getting is from here to here, that's 50, so it gives me smaller increments of standard deviation. So you can see we have a standard deviation of -5 there. So we're looking for that in time. You can see we didn't get it. That's fine. We're going to work on that. Remember, standard deviations are within 3 to 5 pips. That's, in my opinion, the realm of error. Okay, where it can be within that vicinity and still be good enough. And the standard deviation on the upside, same way. Looking for 74.89 4 pipettes. And the high actually comes in at 74.93 and a half. So it's within 5 pips. Okay. The next trading day, this is where we're trying to take this setup. Same thing, we're using flout, using the rules with the standard deviations from central bank dealers range, Asian range, and flout. So same thing here. I'm showing you the sessions, London Open, New York Open. So we're looking for key turning points. We're looking for sell setups. What's the bias? It's bearish. We're aiming for a run below that low here. And we anticipate what? London creates an important high or a high of the day, and then it expands down into New York Open and potentially even later into London Close. But we're using these two time zones, if you will, in terms of kill zones. And then we have the element of the London Open price action. So we want to get some measurements on this trading day that would give us the objectives for that fair value gap. So at 2 o'clock in the morning, it trades up into that fair value gap there, and we're expecting price to trade down. How far? Well, obviously, we're going to look for it to go below there. But let's add some precision to it. Standard deviation, here to here, measured down. We have flat calling for negative 1.5. The level comes in at 73, 94, and 4 pipettes. That's what we're noting here. And if you look at the previous day's standard deviation, it's 73, 90, and 7. So again, within 5 pips variance. So we could split that range in half between this level and kind of aim for the midpoint, or we can just take that level here plus the spread, and that would be fine as an objective. But we can take the swing projection idea that I've taught you, high to low, and that projection of negative 1 comes in at 73, 92, and 1 pipette. That is the exact low of that candle, 73, 92, and 1 pipette. So we have a confluence of factors coming together within the New York kill zone, giving us a precise entry, precise exit, targeting initially the sell side liquidity over here. So when you walk through your day and you're looking for short-term trades or day trades and you're trying to determine what it is you're trying to aim for, obviously you have to have the bias. Okay, it's going to be framed on the higher time frame. When you're looking for these setups, you can use the London Open or New York Open kill zone. Preferably, if you can, try to do London Open. But if you don't have opportunity to be trading it, at least use London Open's kill zone setup as a kind of like a bias, or support to bias. If you were to use the New York setup, it would be this high, low, optimal trade entry. Right in here is your optimal trade entry. And you would look for a lower time frame area in here for fair value gap or something that would be a premium array. And it sells off, and you can use the same targets based on all the things that I've outlined here. So when you're using standard deviations, this is one of the hardest things that the students have been able to come to grips with, because there's variables here. Okay, so when we go through these standard deviations, you're doing multiple ones, so you're getting an idea where it could potentially go, and then you're going to have to determine which one you're going to pick. Now, I've shown many examples of this. Okay, and if you go through your old data and you backtest, you'll see many instances of precision elements like this that it's undeniable. But the problem is you want it to be easy, where it's just A, B, C, 1, 2, 3. It always works the same way. It's not going to be like that. Okay, it's never going to be just that simple. So there's going to be a variable of measuring the wicks like I'm using, or using the bodies. And what you're doing is you're looking for which one of the ranges between the low and the high is giving you the most confluences between the previous day and the day you're trading. This is a Tuesday, so you're also building in the idea that maybe there was a high formed for the week here on Monday, and then on Tuesday you're looking for the rollover and continuation, because we already had a nice move away from that. So there's a lot of factors, obviously, with model number 5, but you can start to incorporate these elements in your other trades. If you're using another trading model, or if you're back testing, always try to do these measurements. Okay, and what will happen is you'll start getting better at it, because I didn't learn how to do this to sit one and done and knew how to do it. It's not how it worked. It took a lot of years of fine-tuning this, so that way I'm looking for certain things to repeat. You're not going to know all the time. Okay, all you need to know is a rough idea on the trades that you're looking to take. If it's going to be based on like intraday, either scalping or intraday, that's the only benefit really I think Model 5 is going to give you. Otherwise, you don't really need these things. There's other things that provide just as well, higher time frame objectives that you don't need to be this precise. And if you're worrying about trying to be this precise, and that's like the only definition of you being successful here, you're missing the point. Okay. If anything, this communicates the markets operate under an algorithm, and they refer to specific times for measurements for standard deviations above and below the market price within the context of the bias that would be expected, bullish or bearish. Okay, and then bringing in the elements of time. So the short here at the fair value gap, do you need this fib from here to give you that low? No, because you already know logically that you have relative equal lows over here. That's a first partial. And then below that low here, which is previous day's low, is sell side. So as soon as it hits that low and goes below it by 1 pip, that would be enough for you to consider an objective to cover the short. Do you need to be trying to get out at that price? No. But learn to study your previous moves, either by back testing or using it with your current trade to see if these ideas pan out. Over time, your precision and the appreciation for how these markets price and book will obviously increase over time. All right, so hopefully you found this one insightful. Until next time, be safe.